Are you looking to add more quality stocks to your portfolio? If so, this could be the video for you. I'm looking to do the same. So welcome to Finance with JCL, and today we're going to look at a quality stock, or a potential quality stock for your portfolio, and that is Visa. Usual disclaimer before we start, this is not financial advice, it's just my own personal review of Visa, not a buy, hold or sell recommendation. Let's dive into the screen and look at Visa. Right, so my objective here is to determine if Visa is a good investment for my portfolio and a quality stock. I'm going to be using this investing checklist I've created, which is borrowing heavily from Terry Smith's teachings of how he defines what a quality stock is. So first of all, Visa was founded in 1958, so it has a very long history of surviving recessions, business instability, market instability, and so on. I think a lot of people probably know Visa, so I'll keep it brief here. They're a payments technology company. They're described as worldwide, and they're very, very large. Market cap of Visa is around about 400 billion. So this isn't an investment that's going to 5 or 10x quickly. So that's something to bear in mind depending on what you're thinking about the investor strategy. And if you look at my most recent portfolio update, and every update I do, I calculate the run rate that I need in order to hit my investing goal. Last count, I think it was actually 9.6%, but rounding up to 10, that's the minimum return I'll need per year for this to be a good investment for me. So we're going to start off by looking at the number one metric, return on capital employed. I'm going to use the TIKR terminal to get the information here. I think there's a link I can leave in the description below for this. It's a really good site for getting historical financial data. Return on capital employed here. Okay, the last 5 years and then the latest trailing 12 months. I drop that into my template, and that's given me a value of 27% as an average. Now, the minimum is 20% for a quality business that I've set for myself. Ideally, I want it to be about 30, because this is 27%. So it's above minimum, but it's not quite the ideal. So I'll give that an orange. So it looks like Visa is a business that invests in itself well to grow. So next we'll look at gross margin. That'll give us a clue to the pricing power and the ability to deal with potential inflation. So there's actual inflation at the moment, the way things are going. Gross margins here are absolutely massive, so that gets certainly a green on the sort of at a glance assessment. Now I want to try and look at the profitability of their operations. So if they're good at investing into themselves, they've got good pricing power. What's the profitability of those operations? And that's really incredible. Really, really high operating profits here. This is a very interesting company from a quality perspective. And now we're going to have a look at the cash conversion, because can they translate profit into free cash flow, which is what Warren Buffett calls the owner's earnings. Free cash flow here, very big numbers. Back to the profit and loss account, and we're going to get the net income. Okay, so that cash conversion is above 100%, so that is certainly green. So this very much is a quality company, I think we can say, for this top section. It might be a quality company, but there's other factors to consider. So I want to consider how likely is this company to fail, and then valuation. And I'm not trying to buy with a massive margin of safety or undervalued. That isn't the Terry Smith approach. For that portion of my portfolio, which I want to be up to 50%, the quality companies, I just want to make sure that I don't overpay and that the company's going to be around a long time. Because by the sort of mathematics of compounding with high return on capital employed, I'll make a lot of money even if I pay a reasonable price rather than waiting for a super undervalued price. First thing then, chance of failure is the interest cover. Interest cover is 30, so that's looking really, really good. Move to the debt to equity next, see how much debt they're carrying and how it relates to the equity of the company. 3 yen here, 58%. And then the current ratio, sort of the ability to pay the day-to-day bills. I'm not imagining this should be a problem. Okay, so that's 1.62. That's absolutely fine. So I'm very happy that Visa is a quality company and that it has a low chance of failure. Now I want to then look at the free cash flow yield. A lower free cash flow yield is a more expensive company, and a higher free cash flow yield is a better value. I want to compare the free cash flow to the market cap, see what will come out as for this period and then also the historic periods. Okay, so we've got almost 18 billion of free cash flow and 400 million at market cap, so that gives us 4.45%. So actually, it's not passing that buy point at a reasonable price at the moment. Now, let's say Visa lost a quarter of their market cap, so they lost 100 billion. Yield then would be getting towards 6%. So Visa needs to be about a quarter cheaper than it is today. My assessment for me to look at buying them. And if you have a look at that share price, that's about 200. Take a quarter of that, that'd be about 50. So you're probably looking at somewhere in the region of about 150. Now the 52-week low is 175, so it hasn't quite got down to that ideal level yet. Look at the chart for the last 5 years. The last time we're down at 150, actually during the pandemic time, and it's for a very, very brief period. And then you're going all the way back to sort of start of 2019, so 3.5 years ago. Now there are some other factors that I consider just to get a wider picture of the company. And ideally, I want a customer or company rather with a non-concentrated customer base. They're not reliant on 1 or 2 contracts. And that's certainly the case here. So that'd be a green. Is it sort of a repeat purchase type thing? And ideally, you want something like pet food. It's regular, it's predictable, and you're not going to cut that. Now, with Visa, of course, it's used for both necessity and discretionary purposes. So perhaps there's a little bit of risk there, but probably not a huge amount. I think the industry is very suitable. I haven't even looked at the dividend. I'm not really that bothered about that, but let's just have a quick look just to get the full picture. So Simply Wall Street has a dividend yield of just under 1%, and the ex-dividend date is coming up November 9th, so that is less than 2 weeks away at the time of recording this video. You can have a look at dividend per share was 22 cents. It's been going up steadily, and it's now 180. So in the course of around about 9 to 10 years, that's a very significant percentage increase in the dividend. Payout ratio is very low, you're looking at about 1/5, and the future is predicted to be 1/5. It looks like the dividend is very affordable. Dividend could be grown if they want to, but because they've got a good return on capital rate, reinvest back into their business at what was it, average of 27%, why would you want to pay a higher dividend? I think all of these are absolutely fine. And then in terms of the growth, could the company grow? Yes. Now the future growth rate, this be interesting to see. As you can imagine, well covered by analysts. Next 5 years, they're saying 16.75% on Yahoo, which is a very significant growth rate. Simply Wall Street is saying 11.5% for future growth, both double digits percentages. So the current PE, just correcting the formula there, is 27, and the PE in 5 years could be just 16 if this growth rate is applied going forward, potentially. And I look for some avoidance flags. So is it a SPAC? Should know better. I've burnt with that before. Not. Is it an unprofitable company? No. Is it a cyclical industry? No, I wouldn't say it's cyclical. Does it require huge capex? It does not, but let's check that. Have a look at the cash flow statement, and capex is less than $1 billion each year. And there's a good check here, and this is one that Terry Smith always flags with Tesco, where earnings per share kept going up and everyone focuses on earnings per share. But actually, return on capital was going down, so they were becoming less and less efficient at getting that growth. And I don't think that is the case here. Return on capital isn't going down. We're looking at very consistent numbers there, and in fact 31% for the latest period. Finally, do I already hold a company in this sector? Because I don't want excessive exposure to a particular sector or owning multiple competitors. Why not just own the best one in most cases? And I would say that I don't hold I hold American Express actually. You could argue that that is certainly a competitor to a large degree. I do hold that sector already, but it is under 2% of my portfolio. So I'm not even buying these at the moment anyway, but it wouldn't be a problem with excess exposure. And I think they are both very high quality companies. So there we have it. That is my new checklist for myself for buying quality companies. So my portfolio strategy, to reiterate, I want up to 50% in these quality companies that pass this criteria, and this is my new way of assessing a quality company. And it's a checklist to reduce the chance of me making mistakes, as I've made some mistakes recently on people like TTCF, which clearly isn't a quality company. Focuses on getting these quality companies. This is my method for checking those. So I'd love to hear what you think about this. If you'd be interested in me, perhaps getting a copy of this out there. And interestingly, Terry Smith, if you look at his portfolio holdings as of 30th of June, Visa is actually one of his biggest positions. That looks like it's in roughly the top 10, and it's just under 5% of his portfolio. So he agrees it's a quality company. Now, we've come to the end of this video, but do check out the video that's popping up on the screen now. And that video is going to show you how my portfolio is looking and the quality companies, how they're performing within my portfolio. So check it out. It's well worth a watch.